Hello, and welcome to part 2 of our 4-part Finance 101 series entitled, What is the Stock Market and How Does It Work? In this series, our objective is to educate our viewers on some basic finance terms, processes, and products that we feel are extremely important to have a working knowledge of. This information will not only help you to plan and achieve financial security now, but in retirement as well. It will also give you peace of mind while going through the process. In keeping with our Finance 101 theme, we will try to present information in as easy to understand, non-financial language as possible. Before we get going, I do need to take care of a few housekeeping items. I would like to remind everyone watching that the information being presented is for illustrative purposes only. We talk about a variety of products and services and share many hypothetical situations, none of which are meant to offer any specific investment advice or recommend any products to any of our viewers. As mentioned earlier, part 2 of our series is entitled, What is the Stock Market and How Does It Work? As we did last month, we will start by defining some financial terms commonly used in relation to the stock market that most likely all of you have heard but might not know exactly what they mean. We will try to break them down into the simplest language possible. So here are 13 commonly used terms and their definitions as they relate to the stock market. In the financial world, a market correction is defined as a decline of 10% or more in the price of an entity from its most recent peak. Corrections can happen to individual assets, such as an individual stock or bond, an index, such as the S&P 500 or NASDAQ, or the entire market. An asset, index, or market may fall into a correction either briefly or for sustained periods of time, such as days, weeks, months, or even years. However, the average market correction is relatively short-lived and lasts anywhere between 3 and 4 months. You can think of corrections like that spider under your bed. You know it's there, but you don't know when it's going to make its next appearance. And while you might lose sleep over the thought of a spider under your bed, you shouldn't lose sleep over the thought of a market correction. They're actually healthy for the market. Bull and bear markets are the condition of a financial market in which prices are rising or are expected to rise, or in which prices are falling or are expected to fall, respectively. The terms bull and bear market are most often used to refer to the stock market, but can be applied to anything that is traded, such as bonds, real estate, currencies, and commodities. In a bull market, traders have confidence that prices are good, so they are optimistic about the future. While there is no specific or universal metric used to identify a bull market, perhaps the most common definition is a situation in which stock prices rise by at least 20%, usually after a drop of 20%, and before a second 20% decline. Since bull markets are difficult to predict, analysts can typically only recognize this phenomenon after it has happened, and bull markets can last for months or even years. Conversely, bear markets are associated with declines in an overall market or index. But as with bull markets, individual securities or commodities can also be considered in a bear market if they experience a decline over a sustained period of time. A bear market is typically described as a condition in which prices fall 20% or more from their recent high amid widespread pessimism and negative investor sentiment. Bear markets also may accompany general economic downturns such as recessions. Here's a little trivia for you. The commonly held belief about the origin of these terms suggests that the use of bull and bear to describe markets comes from the way the animals attack their opponents. A bull thrusts its horns up into the air, while a bear swipes its paws downward. These actions are metaphors for the movement of the market. If the trend is up, it is a bull market. If the trend is down, it's a bear market. Securities are fungible or interchangeable and tradable financial instruments used to raise capital in public and private markets. The two most basic types of securities are stocks and bonds. Stocks are equities and give the customer ownership in the security, where bonds are debts and give the customer loanership. A third type of security is a hybrid, which combines aspects of both debt and equity. An asset class is a grouping of investments that exhibit similar characteristics and are subject to the same laws and regulations. Asset classes are made up of instruments which often behave similarly to one another in the marketplace. The four main asset classes are equities, or stocks, fixed income, or bonds, cash and cash equivalents, and alternative investments such as real estate, commodities, futures, and some tradable collectibles. Financial advisors focus on asset class to help investors diversify their portfolio. As mentioned a few slides ago, a stock is a form of security that indicates the holder has a fraction of ownership in the issuing corporation. Corporations issue or sell stock to raise funds to operate their businesses. Units of stock are called shares. There are two main types of stock: common and preferred. The main differences are that preferred stock usually do not give shareholders voting rights, while common stock does, usually at 1 vote per share owned. And while common stockholders have voting rights, they are last in line when it comes to company assets, so preferred stockholders are paid dividends first. A bond is a form of security that represents the debt of its issuer, such as governments, corporations, or other organizations, and is sold to investors. When you purchase a stock, you are buying a stake in the company. It is yours, and you get to share in the growth and also in the loss. A bond, however, is a loan. When a company needs funds for any number of reasons, they may issue a bond to finance that loan. Much like a home mortgage, they ask for a certain amount of money for a fixed period of time. When that time is up, the company repays the bond in full. During that time, the company pays the investor a set amount of interest. Bond prices vary opposite of interest rates, so if rates rise, bond values fall, and vice versa. Bonds make good diversifiers for investment portfolios, and since they also tend to pay regular and stable interest, they are well suited for those on a fixed income. Mutual funds are another type of security made up of a pool of money collected from many investors to invest in securities like stocks, bonds, money market instruments, and other assets. The value of the mutual fund depends on the performance of the securities within it. So when you buy a unit or share of a mutual fund, you are buying the performance of its portfolio, or more precisely, a part of the portfolio's value. Investing in a share of a mutual fund is different from investing in shares of stock. A share of a mutual fund represents investments in many different stocks or other securities instead of just one. The overwhelming majority of money in employer-sponsored retirement plans goes into mutual funds. Index funds are a type of mutual fund whose portfolio of stocks or bonds is designed to mimic the completion and performance of a financial market index. Index funds are passively managed and therefore have lower expenses and fees than actively managed funds. They seek to match the risk and return of the market on the theory that in the long term, the market will outperform any single investment. There is an index and an index fund for nearly every financial market in existence. An exchange-traded fund, or ETF, is a basket of securities that trade on an exchange just like a stock. Exchange-traded fund share prices fluctuate throughout the day as the ETF is bought and sold. This is different from mutual funds that only trade once a day after the market closes. ETFs offer low expense ratios and fewer broker commissions than buying the stocks individually. Both ETFs and mutual funds hold portfolios of stocks and/or bonds, and occasionally something more exotic, such as precious metals or commodities. In an ETF, buyers and sellers are doing business directly with one another, so the managers have far less to do, making ETFs more liquid and cost-effective. The simplest definition of track record investing is buying stocks based solely on how they have performed in the past. And one of the few absolutes in investing is that past performance is no guarantee of future success. Market timing is an investment or trading strategy where a market participant attempts to beat the stock market by predicting its movements and buying and selling accordingly. While feasible for traders, portfolio managers, and other financial professionals, market timing can be difficult for the average individual investor. What can be said with certainty is that it is very difficult to time the market consistently over the long run successfully. If I were to give you the last 10,000 Powerball winning numbers, would you be able to tell me the next 6? Stock picking is essentially the opposite of track record investing. It's when an investor attempts to pick a stock or stocks that will outperform the index over a period of time based on the current available information. When it comes to investment strategies, we have dubbed the last 3 terms as the pyramid of destruction. As you process through the 13 terms we have just defined, it becomes clear that the market is made up of securities. They come in the form of stocks and bonds, or a hybrid of the two, and they can be utilized in many ways within your portfolio. When it comes time to invest, do you know if you're investing into a market correction, a bull market, a bear market? And are you taking the appropriate steps necessary to craft a strategy for your retirement? Or are you taking part in the pyramid of destruction for your portfolio? Those of you who have worked with us over the years know that one of the 3 pillars of our investment philosophy is not to engage in stock picking, track record investing, or market timing. So why teeter between all the noise when you can have a well-diversified portfolio that is invested worldwide to potentially create peace of mind for you and your family? Have you ever tried to take a photograph of the invisible man? Prove that a tree falling in the forest makes no sound? Shove a square peg through a round hole? Or even name that tune in 8 notes? Well, we're not going to be doing any music trivia today, but we are going to try to explain the stock market in 8 slides. The stock market refers to the collection of markets and exchanges where regular activities of buying, selling, and issuance of shares of publicly held companies take place. While some people use the terms stock market and stock exchange interchangeably, stock exchanges are a subset of the stock market. They are a place where securities are bought and sold. The stock market is the sum total of all the stock exchanges and the securities contained within them. Indexes, then, track various companies that are traded on an exchange by their market capitalization or share price. For example, the S&P 500 measures the value of the 500 largest publicly traded U.S. corporations by market capitalization, while the Dow Jones Industrial Average measures the 30 largest U.S. companies based on share price. These are the blue chip stocks, huge companies with outstanding reputations and long histories of success. Then there's the NASDAQ 100 Composite Index, which measures the value of the 100 largest technology companies. The stock market operates similarly to any other commodity. Let me give you an example. You just bought a new house and now you have to furnish it. If there is only one furniture store to shop at, they can charge whatever they want because you have no other place to go. But if there are a large number of furniture stores to choose from, they will have to compete with each other for your business. This creates a fair market price for the furniture buyer. In a nutshell, the stock market provides a secure and regulated environment where market participants can transact in shares and other eligible financial instruments with confidence and low operational risk. Before we wrap things up, I want to take a quick look at the global picture. The world's population of approximately 7.8 billion people drives the global market on a daily basis. It keeps the market perfectly random and unpredictable. The world market is an ongoing cycle of buying and selling. There are stock exchanges all over the world, and as night falls on the Americas, the sun rises on Europe and Africa, and then Asia and Australia, before coming full circle back to the United States for another day. This is why it is important to have a well-diversified global portfolio of securities within your investment accounts. Here's another way to look at the world market. As you can see, not all countries are created equal. This pictograph shows the percent of world market capitalization by country. The U.S. is in dark gray, developed markets are in olive green, emerging markets are in dark green, and other markets are in light gray. It doesn't take long to figure out which countries carry more wealth. The stock market is one of the most vital components of a free market economy. It allows companies to raise money by offering stock shares and corporate bonds. It lets common investors participate in the financial achievements of the companies, make profits through capital gains, and earn money through dividends, although losses are also possible. While institutional investors and professional money managers do enjoy some privileges owing to their deep pockets, better knowledge, and higher risk-taking abilities, the stock market attempts to offer a level playing field to common individuals. In this presentation, we have defined some commonly used terms, explained the difference between the stock market, stock exchanges, and stock indexes, taken a brief look at global markets, and addressed the significance of the stock market. At One-to-One Wealth Strategies, in conjunction with the Plan Member Financial Center, it is our job to be the professional team of financial experts that gives you greater peace of mind throughout the process of developing and carrying out a sound financial retirement strategy. We hope that this information has increased your understanding of the topics covered and decreased your level of apprehension regarding saving for retirement. We also hope it has generated some questions, as this presentation was designed to be at the 101 level. We encourage you to share this information with family and friends and reach out to one of our knowledgeable financial professionals to answer your questions. And don't forget to ask for a complimentary personal retirement consultation. Until next time, on behalf of One-to-One Wealth Strategies, be safe, be healthy, and be educated.